Welcome back to Investing Talk Podcast, and Merry Christmas.
Today we're looking at HIMS and HERS Health.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
Right. And today we're really digging into whether this telehealth company can make that jump, from just a high-growth name to a sustainable, profitable platform.
Especially with some of the headwinds we're seeing. But the big story, I think, is that HIMS and HERS is really proving that this direct-to-consumer model can actually work at scale and, most importantly, be profitable.
Okay, so let's start right there with the financial momentum, because the numbers, the execution has been pretty exceptional.
It has.
Looking at the top line, Q3 2025 revenue came in at what, $599 million? That's phenomenal scaling.
It is, but we have to add a little context there. That Q3 number, it represented 49% year-over-year growth.
And 49% is nothing to sneeze at.
No, not at all. But it is let's call it a normalization from Q2, which posted frankly, an insane 73% year-over-year growth rate.
So the rocket ship is maybe leveling out a bit, settling into a really, really fast orbit.
That's the perfect way to put it. You can't maintain that initial booster phase forever. But this new cruise speed, 49%, is still it's lapping the rest of the telehealth sector. They're taking market share.
And it's not just about getting bigger, right? It's about getting better, more efficient. They're delivering on the bottom line now.
That's the whole story. This operational leverage is the key. In Q3, they posted a net income of almost $16 million.
A real profit.
A real profit. And adjusted EBITDA was over $78 million. Now, that's a little down from Q2's $82 million, but think about it. They're absorbing huge growth and still pulling in that kind of profit. The platform is maturing.
Okay, so if it's maturing, that means each new customer, each new dollar of revenue should cost them less to bring in. That has to show up in the forecast, right?
It does, and this is where it gets really compelling for investors. Management held their full-year revenue guidance steady between $2.335 and $2.355 billion.
So they're confident.
Very. But the real kicker is the earnings projection. For 2025, analysts are expecting a massive 77.8% jump in earnings per share compared to 2024.
Wow.
And then you look to 2026, sales growth is forecasted about 17.6%, but earnings growth, that's projected at 22.3%.
Whoa, hang on. So their earnings are expected to grow faster than their sales?
Exactly. That's it. That is the textbook definition of margin expansion.
It means the business is just getting more profitable with every sale.
Precisely. Once they cover their fixed costs, the tech, the doctors, all that marketing, every new subscription dollar just drops more and more to the bottom line. It's the clearest sign that the model is working efficiently.
And management isn't just saying this on calls. They're putting their money where their mouth is.
Let's talk about the buybacks.
A huge signal of conviction. They already burned through a $100 million buyback program.
And now they've reloaded. Big time. A new $250 million authorization that goes all the way out to November 2028.
That's a long-term commitment. It basically screams, we think our stock is cheap.
It's management saying this is the single best investment they can make with their capital, but at the same time, they're not just returning cash to shareholders.
Right. They also raised that huge war chest, the $870 million convertible note.
And that's all for strategic growth. It's all aimed at making their competitive moat even deeper.
What specifically are they targeting?
3 main areas: AI integration, better diagnostics, and pushing into brand new care categories. They're moving from just being a digital pharmacy to a full-on digital health platform.
That makes sense.
Yeah.
Let's talk about that moat. The foundation is this sticky subscription model, right?
Totally. It gives them that predictable recurring revenue. They're sitting on about 2.5 million subscribers now, and that base is growing at a really steady 21% a year.
And it's sticky because, once you're set up with a doctor for a sensitive issue, you've got your records there. You're not going to just switch on a whim. It's not like changing your Netflix password.
Not at all. And they deepen that friction by offering more services. You might start with one thing, but now they do mental health, dermatology, weight management.
So you get larked into the ecosystem.
Exactly. And now they're adding things like sleep and pulmonology. Every new service just increases the lifetime value of every single customer they have. They're becoming a one-stop shop.
Okay, so the fundamentals look solid. The strategy is clear. Let's pivot to the technicals. What is the market telling us?
Well, the price action has been extremely bullish this year. The stock is up, almost 45% year to date. It's crushing the rest of the healthcare IT sector.
But we've seen a little weakness recently, a bit of a pullback in the last week or so.
Correct, about a 6% dip. And that can spook people, but analysts are seeing it more as an accumulation phase, a chance for big money to get in before the next leg up, given how strong the fundamentals are.
And some of the quantitative signals are just wild. We saw one analysis pointing to a 112-to-1 risk-reward setup. I mean, what does that even mean in practical terms?
It's basically the quants saying the potential upside is just astronomically higher than the perceived downside at these levels. For every dollar of risk, they see over $100 of potential reward. Traders can't ignore a signal like that.
And the analyst price targets seem to back that up.
They do. The median target is around $48. But you have some serious bulls out there. BTIG has an $85 price target on it.
$85, that's what, 120% upside from here?
Roughly, yeah. And even if you look at others like Canaccord at $68 or Barclays at $48, the street consensus is that there's a clear path higher.
Okay, so that's the analyst. What about the institutions? Is the smart money actually buying this dip?
Oh, yeah. The latest 13F filings are pretty revealing. You had Title Investments add over 2.7 million shares. They increased their position by almost 1,800%.
1,800%.
Yeah.
That's not just adding to a position, that's building a brand new high-conviction one.
It's a massive move. And you also saw Renaissance Technologies, one of the top quant funds in the world, add over 2.2 million shares. So while some people took profits, it looks like the really strategic money is rotating in.
Okay, we've laid out a pretty compelling bull case.
Yeah.
But we have to talk about the risks. What's the bear case here?
Number one, without a doubt, is the litigation risk. There's a securities fraud class action lawsuit against them.
What's the core of that suit?
It alleges they made some materially false or misleading statements about promotions for a popular weight loss drug. And since weight management is such a huge growth area for them, this is a serious risk.
So you've got potential settlement costs, reputational damage. It's a dark cloud.
It is. But on the mitigation side, that $78 million in quarterly EBITDA gives them a pretty big cushion to absorb a settlement. And importantly, the lawsuit covers a period before Q3. The fact that their Q3 results were so strong suggests they might have already cleaned up whatever compliance issues were there.
Interesting. So the results themselves are a counter-argument. What's the other big risk? The growth slowdown.
It is. You know, that drop from 73% growth to 49% is not trivial. And the guidance for 2026 is only 17.6% sales growth.
So the fear is that they hit a wall.
A subscriber plateau, maybe?
Mm-hmm.
Or that bigger players, Amazons and CVSs of the world jump in more aggressively and start a price war.
Which would crush those margins we were just celebrating.
That's the bear case in a nutshell. That future growth will be much more expensive to get. But again, that's why they raised the $870 million. They're not waiting for that to happen.
They're using the cash to find new growth areas.
Exactly. The move into sleep, diagnostics, using AI, it's all about proactively expanding their market so they aren't just fighting over the same pool of customers.
Okay, so looking ahead, what are the key catalysts we should be watching for?
First is the Q4 earnings report, probably late January. We need to see them hit their guidance and, crucially, confirm that margin expansion is continuing.
And any news on the lawsuit, I assume.
Right. A settlement would be a huge catalyst, just removing that uncertainty. And then, in the first half of next year, we need to see tangible products coming out of that AI and diagnostics investment. We need to see that cash is being put to good use.
So the picture we've drawn is pretty clear. You have a profitable, high-growth company. Management is buying back stock, hand over fist. Institutions are piling in. But you have to weigh that against the litigation and the slowing growth.
Absolutely. When a company is growing profits and management is signaling this much conviction through buybacks, it creates a really interesting asymmetric risk-reward setup. The next year or two will really show if they can make that final leap.
The leap from a niche digital service to a kind of centralized digital hospital, that seems to be the end game.
That's the $85 question right there.
Yeah.
If they can pull that off, the upside is massive.
A great way to frame it. The challenge is as much about identity as it is about execution. If you learned something new about HIMS and HERS today, remember to subscribe for more analysis in the weeks to come.